Hey investors, welcome to another episode of our series Journey to 10 Crore by Vishal Vealth View. So, in today's episode, we'll be discussing index funds. What are index funds? What are the best types of index funds? What are different types of index funds? And what are the index funds that I'm investing in right now? So, let's just jump right into the video and let's start talking about index funds. So, what are index funds and what's the fuss all about? So let me give you an example. Over here, we have one such index called Nifty 50. You must have heard about Nifty 50 on news channels and investors talking about it on different shows in CNBC TV. So let me first try to explain you the definition of what Nifty 50 is. The Nifty 50 is a benchmark Indian stock market index that represents a weighted average of 50 of the largest Indian companies listed on National Stock Exchange. Now, National Stock Exchange NSE is a place where different investors can come in and trade their equities. And this particular index is tracking what's the total market capitalization of top 50 companies that are listed in India. Now, if we see what are these companies include Reliance, TCS, HDFC Bank, Bharti Airtel, ICICI, Infosys, and the name goes on. Now, this is an index. This index is defined on the basis of certain rules by National Stock Exchange and the analyst of National Stock Exchange. And there are different funds that tracks this index. That means when you are investing your money in that particular fund, they're going to buy this particular index, which means the underlying asset that's represented by the company in the same way as it's present in this index. That's the fund of index fund. So now we have understood what index funds are. Let's talk about what are the different index funds that are available for you as an Indian investor and what are their risk profile. And does it make sense for you to invest in any one of these index funds for your passive wealth growth? So the first index fund I'm going to talk about is Nifty 50. I'm sure you have heard its name many times in your life, from your childhood to your adulthood. It comes up in news channels and multiple places. So what is Nifty 50? Nifty 50 is a weighted index. That means the constituents of this particular index is going to be dependent on the size of the market capitalization in the Nifty 50 space. It comprises of top 50 companies of India by size, and the risk profile for this particular index is medium. Where the lowest risk profile that I consider is of FD, and the highest risk profile is of investing in startup, where money can absolutely go to zero. The rebalancing of this particular index happens semi-annually. What does that mean? It means that sometimes some companies grow big and some companies lose their steam. And that's why new companies are added in this Nifty 50 index, and some old companies are removed from this Nifty 50 index. So essentially, this will make sure that you are always investing in winners. And we know that in the capitalist world, you have to innovate to get ahead of your competition and be winning in business. The top 50 companies that you are looking at right now, I'm pretty sure half of them will not even exist 20 years of from now or 30 years from now in Nifty 50 space or top 50 companies of India space. So when you invest in this index, the index intelligently handles when do I need to rebalance, when should I move the money from one equity to another, and you can live tension free and just go about living your life. So what particular mutual funds are offering this particular index fund? Right now, SBI is the primary mutual fund house that's issuing SBI Nifty 50 ETF and an index fund on Nifty 50. There are many fund houses, but this is the lowest expense ratio mutual fund or an ETF that you can buy out without even thinking about any risk. The risk in investing in Nifty 50 is relatively minimal to any other stock investment or equity investment because the money is diversified. Let's take a look at SIP returns on Nifty 50 over last 1, 2, 3, and 5 years. And these are real returns. So as you can see, the annualized return that you're getting is usually about 15%. Now we have also observed that in the last 4, 5 years, the markets have observed an amazing pull in India. So take that with a pinch of salt because equity markets do not work in a linear way. Some years you get good returns, some years the entire market is flat and you don't get it and you don't generate any return. But what your aim should be is to minimize the risk profile. You should be able to live with the risk when the market is going 10% and 20% down. And Nifty 50 gives you that ability. Now, here's the catch. Most of you have entered the workforce or are planning to enter the workforce. That means in some years, you're going to start earning money. And I'm quite sure majority of you are already earning money by having a job. If you would have taken a look at a salary statement, you would have noticed a contribution to PF or Provident Fund. Now, this is the money that you're investing right now with the government so that your retirement can be saved. Take a look at this article. EPFO, Employee Provident Fund Organization, to invest 50% each in Nifty and Sensex. What does that mean? It means the money that you're giving to government for retirement, they're eventually investing that in Nifty 50 index and Sensex index to generate returns. And they're going to give you 8.5 or 9% return, which I agree might be tax free. And whatever extra returns that they're going to generate on that capital, they're going to keep it with them. So investing in Nifty 50 for your retirement is a sound strategy because government is doing exactly the same thing through EPFO. Talking about a second index, Nasdaq 100. Now, this is again a weighted index, but it's heavy on tech. It usually or mostly contains tech companies. This index is based out of US entirely. This index is not present or managed by any of the listed entities in India. It's completely managed by US registered exchange, I believe. Now, this index includes top 100 company of US, which belong to non-financial space. The risk profile I consider for this particular index to be on a medium side because it consists of companies whose product the world absolutely needs. Google is present here, Apple is present here, Nvidia is present here, Microsoft is present here. You name it. Like if you have a company which is solving any problem using tech, it is probably listed in Nasdaq, and that's why it's a tech-heavy index. The rebalancing of this index happens semi-annually. That means every 6 months. And the mutual fund that are offering this particular index in India are Motilal Oswal Nasdaq 100. You can get an ETF for this or an index fund. The catch is if you want to save your money from depreciation against dollar, and if you don't want to open a brokerage account in US directly, then you can buy this particular index fund in India in any of the listed exchanges through an ETF or a mutual fund route. Let's take a look at SIP returns for this particular index over a period of 1, 3, 5, 10 years. As you can see, the annualized returns are always above 20%, which is an amazing number. But you should ask the question, why is that? Why is this index performing so well, even though it's weighted average and like it consists of 100 companies? So what's the reason? I was reading one article a few days back, and it talked about how 90% of the patents that are being filed in US belong to top 20 companies of Nasdaq 100. That will give you a sense of level of innovation that's happening in in these companies. These companies employ the best brains that's present on the planet Earth. No matter what, they'll find out a way to win again if they have a setback. That's why the results of these companies look absolutely phenomenal. And if you would have invested in this index, you would have made a lot of money in past 10 years. The third index on our list is Nifty 200 Momentum 30. Now, this index is capped at 5%. That means if you're investing 100 rupees in this particular index, then maximum amount that will be invested in one company is going to be 5 rupees. and the total companies that are present in this index is 30. This is based out of momentum factor and free float. The momentum factor is a factor that's decided based on the current price change or price movement of the equity. And free float is the total market capitalization of that particular equity. It samples from top 200 companies that are present in Nifty. And the risk profile I'll consider on the high end because it's only taking a look at the fact that how much the stock has run up, and it will be included in this list. The mutual fund that are offering this particular index are ICICI Prudential Nifty 200 Momentum 30 in ETF form or in index form. Now, the expense ratio of this particular index is relatively more than Nifty 50, but it's still less than most of the active managed funds. If we see the returns of this now, these are not real return and these are back-tested results that I was able to compile from NSE's website and NSE's paper that they're giving out. But it's pretty impressive. Like in case of 1 year and 5 year, I'm able to see more than 20% returns. But remember, past returns do not promise future returns. But I think it aligns with my philosophy of taking some amount of risk in my portfolio. And that's why I'll keep on investing in this. The next index we have is Nifty Alpha 50. Now, this index is based entirely on alpha factor. It means price movement. That's it, nothing else. It's a it's a different version of momentum, and the holdings are capped at 4%. The sample is taken from top 300 companies that are present in India, and the rebalancing is happening once every 4 months. And this is a really fast-moving index. Companies are included in this index and removed really quickly because the idea is you want to invest in winners as much as possible on short intervals of time and see if those winners keep on winning. The risk profile I'll consider extremely high. This is extremely volatile index, highly volatile than Nifty 50 or any other low volatility index. The mutual fund that are offering this particular index are Kotak Nifty Alpha 50. This is the only fund house that's offering this in ETF form or in index fund form. Again, this index came in reality pretty recently, so we do not have actual result for this particular index. So I was able to compile some back-tested results from NSE website. So these are the back-tested result for Nifty Alpha 50. Take it with a pinch of salt. Again, I'm warning you because past returns do not predict future returns. But as you can see, the returns in 1 year, 5 years, at least in back test, has been pretty decent. And the thing I want to talk about is the beta of this particular index in 5 year horizon, which is relatively lower on the lower end than Nifty 50. The fifth and last index we're going to talk about is small cap 250 momentum quality 100. Now, this index is based out of two factors, momentum and quality. Momentum is entirely price driven. If the stock is running up, it's going to have a high momentum score. And quality is based out of factors such as what's the debt on the company, what's the ROC of the company, what's the ROE of the company, and it's based on various quantitative factors rather than just qualitative factors. Holdings are capped at 3%. That means if you're investing 100 rupees in this particular index, at max 3 rupees is going to be invested in one single company. So your money is pretty much diversified across the small cap space. The sample is 250 small cap companies of India. The rebalancing happens semi-annually every 6 months. New companies are added, new companies are removed. The risk profile of this particular index I'll consider on high end because it's investing based on momentum factor. The mutual fund that's offering this particular index is Mirai Asset Fund House. You can get it through either an ETF or through an index fund by starting an SIP. If we see the results, which again are back-tested results and not actual results, they're pretty impressive. And based on these factors, I am also investing in this particular index. But past results do not promise future results. So If you are planning to invest in these index, do your own research and hit the subscribe button. See you next week. Bye bye.